So we are doing a panel today on Equidebt. We have Punit and Srikanth, who are amazing founders here, BluSmart and Homelane. And we have two amazing VCs who have promised a very controversial debate on the stage on the pre-call. Ritesh from Stellaris and Ishpreet from Stride. Stride is venture debt and much more. Stellaris is purely equity fund. So I'll just start with you, Ritesh, and I know you have a hard stop also. So I'll start with you. How do you look at, first of all, overall equity market, and in your mind, how do you place venture debt or debt, and if you can start from there?
Sure. Thank you, Vaibhav. Hi, everyone. When I saw the title for the panel, I was very confused because it said Equidebt. I don't understand that term, and in my mind, equity and debt are two totally different forms of financing. And the big difference is you don't have to repay your equity equity holders, and if you don't repay your debt holders, you die. So unfortunately, to me, they are two different asset classes and two different ways of financing. When it comes to startups taking debt, again, I have real trouble understanding why startups should take debt at all. And I have certain beliefs as to why debt is actually bad for startups. Usually you take debt. Debt is a very simple product for companies. Someone gives you money, and you generate some positive cash flows, and over the next few years, using those positive cash flows, you return that money back to your creditor. Unfortunately, startups don't generate that positive cash flow for the most part. So how do you justify, how will you repay that? And the risk that places you in is actually very, very significant. Like I said, if you don't repay your creditor, you die. They have a legal right to liquidate your assets and take their money back. And the last reason I think that debt is dangerous for startups is because you are using a very high cost of capital product, your venture capital equity, to repay a low cost of capital product. So, the expected returns on venture capital are 35–40%. You're taking a 35–40% cost equity and trying to repay a 14% debt. So I find some of these difficult to understand for some of these reasons why startups should take debt at all.
And Ishpreet, you're literally on the other side, and your mission usually from a Stride point of view is to promote venture debt and debt from a point of view where equity is not diluted, founders are saving equity for the future, and then capital is used, non-equity capital where it is required, right? So how would you look at what Ritesh just said?
Actually, I have a very big counter view on this, and I have two portfolio companies sitting, so they should speak about this. And I totally believe of the fact that it should not be, especially venture debt, should not be done unnecessarily when it's not required. I've not been a big fan in terms of coming on top of equity rounds and doing venture debt, because largely you're getting paid out of the equity money. So fundamentally at Stride, we have some thesis to do venture debt, and I think both of these case studies also have been very different for us. There's certain business which requires debt, period. It should be done through debt. Certain businesses do not require it. So there are various use cases for every business. If you are a consumer company, we have almost 35 consumer companies, and you have a working capital of 3 to 4 months. You have a distributor offline channel, and you have a vendor channel. You have to pay them. Why to use equity money? It's precious. When you reach a stage over a period of time when you become an IPO-able business, you don't want the founders to have low stakes. So working capital, 6 months working capital cycle, you do 20 crore revenue, you are a 120 crore debt requirement. It should be funded through debt rather than keep on raising equity and doing it. These are high gross margin business which can easily absorb interest cost of the debt. Similarly, if you're a capex heavy business, which is what BluSmart is in, you require capital to procure an asset. That asset should be financed. Right? Similarly, if the use case is merger and acquisition, either you can dilute through Ritesh and take more equity money, or you can finance an M&A through debt. there are various use cases. I can go on. I think we have some 8 standard case studies across industry, commerce players, B2B commerce players, large working capital cycle, international trade. And then classic is in between equity rounds, which we do as well. You come in between equity rounds, extend the runway, you believe it's not the right time to raise equity, the valuations are not great, the multiples are not great, you extend it by another 10, 12, 15 months, 18 months, depending on what kind of cases you're doing. In fact, why to go in startups? Geo Financial Services, listed at a certain price, Reliance Jio has raised tremendous amount of debt before they raised their first equity round. Every business has gone through it. It has to be used judiciously and effectively. You can't use it as a blanket case. I think what he's referring to is classic blanket cases when you raise it on top of equity, do not know what to do with that.
Sure. And, Srikanth, just quickly, taking your and Punit's view. Initially, if you remember as founders, venture debt was always like a loan in our mind, right? And, early days we used to talk about it. Now the awareness is too large. So when you took the first debt, what was the thought process? Why you took it? Why not raise more equity capital and say, debt lena hai?
Can you guys hear me? Right. All right. So thanks for having me here, first of all. So I think the various scenarios and various types of businesses, the question of whether you need debt or not, the answer is very different. In our case, we are a negative working capital business. We do home interiors and we always take advance and then. So pretty much it's a negative working capital cycle. We take the money first. We in fact have 6 to pay the vendors. So we can actually use the money for weeks. So in our case, going to your question, I'll take 2 instances. You either take it because you need money to grow. You don't need money because your gross margins are good enough for you to run the business, but you need money to grow. And for that, you either raise through, ideally through equity. But when you have times like last year, for example, after March, nobody in equity was writing checks, even, if you were Bill Gates' brother. So then you look at other ways of, funding it. And this is exactly what we did. That was actually one instance where last year, our input costs went up by about 10% more. We were doing about 600 crores of revenue. So we lost about 60 crores. We spent 60 crores more than we thought we would. And we had to, fund the next 1 year. And definitely equity money was not forthcoming till margins were getting better. So we definitely took the call of taking debt to get that elongated runway, to get us closer to that. We knew it would turn around. We knew that input costs are not going to be high forever. And they did turn around in about nine months. And after that, we actually have just about turned profitable. So we took the venture debt for us to get the runway and to get to profitability when equity was just not available. We had raised Series D, so even for us it was not. Yeah.
Interesting. Punit, and we just were chatting, right? You guys have taken a considerable amount of debt and we were chatting and you said, hey, debt is one of the key ways we want to go ahead. Of course, equity will be in the mix. Why would you say that?
In our case, we need tons of debt for car financing and for EV charger financing. Today, we have about 1,200 crores of debt for cars. I mean, nobody is giving cars on equity, right? So if you have to finance cars, you have to get them on debt. And we get development financial institutions to finance us at cheaper pricing. So it's all about pricing. I mean, you need to see what is more expensive. Is debt more expensive or is equity more expensive? Equity is very expensive. You have to dilute capital. You have to dilute your stake and you have to raise equity. Debt is much cheaper. If you can get debt at 8%, 8.5%, 9%, it makes sense. And so what we wanted to do was we wanted to get institutional debt. So we went to large institutions who had the ability, capability to finance debt. So we took 1,200 odd crores at about 8.5%, 10%. Now we are speaking to global DFIs who are funding us at lower rates. Now for charging infra, we are very asset heavy. We're building an energy infra and mobility company. And it's a very asset heavy business. So we require tons of capital. We cannot always go out in the market to raise equity, and not everybody understands our business, given who our friends are in the market. So it's important for us to raise debt and raise patient debt. So we raise 5 years, 6 years, 7 years repayable debts with 1 year, 2 year moratorium. And it's very low cost financing debt. I mean, the cost of finance is probably sub 10%. We also have some venture debt that we have from Stride and from various other investors. But we always raise debt whenever we need it. I mean, that's much easier to raise than raising equity all the time. So I think in our case, we'll continue raising tons of debt.
Weber, one thing, actually we are trying to deviate to venture debt. Since the theme is Equidebt, debt is not necessarily on the balance sheet. For example, Mamaearth, one of his portfolio companies, does dealer financing, which means I want to sell my product outside through offline stores. You require debt for increasing your sales. If you enable a dealer to get financing, you will increase your sale as a company. That's enablement of debt, but not venture debt. Similarly, Srikanth does vendor financing for vendors, which is not necessarily a working capital cycle on his books, but on the vendor side, a driver of BluSmart gets funded, which enables more drivers to come on his platform. So it's increasing the business of these businesses as well, which is also debt.
Sure.
It's not venture debt.
Venture debt, it's debt, right? And that's what StrideOne especially focuses on per se. So Ritesh, especially early stage, so are you saying you are not in favor of debt/venture debt, especially from an early stage point of view, because the companies have to build that resilience, etc., and there's less financial discipline, so to say? Or you are saying, irrespective, you are an asset heavy or asset light business, you philosophically wouldn't agree to a venture debt or debt kind of a scenario, and why? I'm just trying to probe down and say why.
No, absolutely. I think there are no absolutes.
Sure.
And let me point out some scenarios where even in our portfolio, I'm very happy for the companies to take debt. I recommend debt and even venture debt in certain cases. I think the easiest case is when taking that debt will lead you to profitability. Let's say you are a unit economics positive business, and with a little bit more capital, you can get to EBITDA profitability. That will lead you to being able to repay that debt from your cash flows alone. I think that's an excellent case to take debt, and you should take not only as much as you can, you should also take it for as long a period as you can, if you can see yourself becoming profitable in the near future. A second case is what I think both Srikanth and Punit were alluding to, which is a way where you can divide your burn into two parts. So let's take Punit's business BluSmart. I would say that they have two kinds of burn. They have a P&L burn on marketing or operations, which is what I would call a high risk burn. But there is also a balance sheet burn, which is a very low risk burn. When they acquire a car, the car is an asset that can be sold anytime. And so the risk associated with with the money that you use to buy a car is actually much, much lower than the risk associated with the marketing. So when you can easily divide, and there are many other situations like this, the Mamaearth situation that you spoke about, Ishpreet, is that kind of a situation. Lending companies take debt to finance, part of their equity portion. That's a low risk debt. That's a low risk burn as well. So in those situations, I would say again, debt is probably preferable to equity. A third situation I would like to highlight is a little nuanced, which is when there is information asymmetry between you and the forthcoming investor, equity investor in your company. Let's say you know that the business is on a tear, you are driving massive growth, you have great unit economics, you are the market leader. It will take 12 to 18 months for the investor community to find that out. If you're very confident that you have a winner in your hands, then there might be a high risk scenario. There might be a scenario where the world might perceive the debt as high risk, but you think of it as a very low risk. That you are going to get funded, why not push the pedal on growth right now? Instead of raising money in 18 months, you raise money in 9 months' time. That would also be a very good reason to take venture debt, but you better be absolutely sure of raising that money in 9 months' time, because otherwise your company is at risk. So there are certain scenarios where I would recommend debt to our portfolio.
And quickly, before I go to Ishpreet or either of them, as a equity VC, right? How do you perceive when you meet a founder or a company, especially in early stage, who would have taken a 30% or a 40% debt compared to equity capital? So as a VC, how would you perceive, is it a taboo in a taboo the wrong word, especially the way we are evolving, but is it still a red flag somewhere you would want to go deeper? How would you look at these guys?
No, when I look at a company for a fresh investment that has debt on its balance sheet, the question I ask the founder, or the question I ask myself is, will I be liable to repay this? Is it debt that can be repaid from the normal operations of the business, or has it been passed on, the repayment of that debt been passed on to the next stage investor? If it is the second one, then I would factor that into the commercials that I would offer for the investor.
Ishpreet, what are some of the cases where you would not recommend founders to take debt or venture debt, especially early to grow stage?
There's a fundamental philosophy about it. Equity can't be replaced by debt, right? So if business requires equity, it requires equity, right? You can't unnecessarily, forcefully give them debt. It is further meaning that they'll die early what they're supposed to do. Because debt, as he rightly mentioned, has obligations. You have to repay it over a period of time, irrespective of however you want to structure that. It will have its obligations to come back and bite you, if not managed properly. So we ourselves, when we enter a company, there are certain naturally gating criteria which revolves around the fact that are we trying to support the business while being a strength, or a liability further in terms of ensuring that the business can go down because they have to repay. So various use cases, right? A edtech business who practically got the number of users traction going for themselves, but revenue has not started scaling up, and they think that debt will be a better way to give take and repay over a period of time. You have to understand the revenue forecast to pay the debt back. So there will be various use cases in which you would not do, but I think the one thing which we started doing, and it's happened recently with more examples and case studies coming out, is trying to work with equity investors very closely. The few things which can be enabler for us to jointly participate. For example, we do an analysis on GST. For any consumer and commerce business, a GST analysis, that analysis, in some cases we have not done the transaction because there were inter-party transactions on GST, which we do out of our NBFC, which can be a very good insight when an equity investor is looking at it. Till the time, naturally, what he mentioned, the debt is not heavy. I think there are ways to work together which makes life easier for all the investors.
Fair enough. And for Punit and Srikanth both, right? So would you recommend in general sense the way world is moving and where we are going, of course, in certain businesses, equity and a debt structure in every round will become a norm? Like, do you foresee this? Do you think like you would prefer more debt over equity as you go along?
Absolutely. I mean, we are in the infra business. I don't know any company who's in the infra space is building massive infrastructure projects, airports, ports, solar power plants with equity. You need tons of debt. So you need definitely equity for infra projects, but you need debt. And we know what we are building. We are building an energy and infra company. So we need tons of debt. We need some equity. But debt should be backed by assets. It should be backed by cash flows. So you should repay the debt. So if you are earning well, if your cash flows are good, you can repay the debt. You should raise debt. And this is what we believe is the path forward for us. But can we raise cheaper debt? Can we raise smarter debt? Can we raise institutional debt? Can we raise global, Macquarie's and McKinsey's of the world, or Brookfield of the world? Can we raise cheaper debt? That's the call that we need to take, and we are taking that step forward as we become bigger now. When we were 70 odd cars, we had expensive debt. Today we are 6,000 odd cars, we have cheaper debt. Maybe when we are 60,000 cars, maybe we have maybe lower debt. So that's the journey that we will be on.
That also bites equally. Some people have taken large debts. That's also biting equally.
And we have seen, right, and again, not to name, but a lot of companies lately who have raised debt also end up in the valley of death, so to say, right? So how would you look at the financial discipline of raising debt and kind of sticking to it?
No, I think going back to your question on, when I would look at it, I think it depends on the age and stage. The principles of the rules of engagement of equity and debt are very different. Equity maximizes for, return. It should have unrestricted return basically, and debt minimizes for risk. So it's completely opposite, so to speak. I think the early stages, when you have not so predictable cash flows, more higher risk, higher reward, is when I would go for equity, because anyway, chances of you getting debt is also close to zero. But when your cash flows start becoming more predictable, and when you can start doing at least part of it using debt instead of equity, definitely I think debt is more cheaper. I would start looking at that when I think what Ritesh mentioned, which is when you can at least fund it partially by your own cash flows. I think to me that is really an important one. But if you're a business which does not have too much of cash flow, then you probably are better off sticking to equity, because otherwise it can really bog you down and can be very, very.
And the point, which Ritesh highlighted, right? Also as a founder thinking, am I passing on this debt to next investor or am I paying it from my cash flows? Because a lot of founders I've spoken to lately would take debt and say, hey, next round we'll figure it out, right? I think that is what one has to take in factor in every possible sense. Time is also up, but any one or two quick questions if folks have? No, nothing. No equity, no debt.
You can just raise your hands if you have any question. I'll come to you.
People are just waiting for 6 p.m. boss. Now it's post-lunch game. So it's no equity, no debt now. How many founders in the room? 1, 2, 3. Who are the people sitting behind? Are you investors? Are you founders? Who are you?
We won't tell you.
Yeah, it's mystery. I will come and meet every one of them after this panel because I'm very curious.
Okay,
Awesome.
we have one question. Yeah,
oh, we have one question. Okay.
Yeah, hi, great panel. Thank you. A lot of interesting insights. I think for me, I'm wondering, like, given where we are in terms of VC funding for startups, I think a lot of startups are trying to raise debt because they're not able to raise equity. What is something that you have seen, and especially for Ishpreet, must be a really good time to be in venture debt?
Yeah, no complaints as such, but so we are doing an analysis. Last month, we disbursed close to 340 crores in venture debt out of 1100 crores of demand, which means demand is not a problem. But at the same time, the responsibility is high because you have to look at these businesses who are trying to duck or who are not trying to receive equity, right? So it becomes difficult because it goes back to the point of cash flows, whether they'll be able to repay over a period of next 12 months by their own revenues. If that's the case, we are positively looking at it. But demand-wise, actually, there have been various kind of sectors which are asking for it. We've stuck by few sectors which we think are very positive in today's time. We've given a lot of debt to consumer and financial services companies, recently in venture debt business. We've also looked at commerce judiciously because that area is going through consolidation. But say an edtech or some of the other sectors who've not been able to fare the way they were 12, 18 months back, we've been slightly away, we're going deeper into the business to understand the regular cash flows. But yeah, good time to be there till the time you can manage your risk.
Thank you, Ishpreet. Shanti, last one, Ritesh has to move. So yes, please.
I have a question for Ritesh. So what do you think about startups who raise equity to actually finance debt, like the BNPL and fintechs, right, who've actually raised money on their balance sheet and then done lending?
So I think, Shanti, that's like using your credit card to make a mortgage payment. Because you are taking a very high cost, very high cost capital to repay low cost capital. To me, it doesn't make any sense to use equity to repay debt. It needs to come either from your cash flows or from the eventual sale of the assets that you're financing. So working capital debt, I understand, even for an unprofitable startup, because eventually you'll sell those goods. But debt that has to be repaid through this very expensive equity, I continue to believe is too risky.
Awesome. This is a topic we can go for hours. So, but in the interest of time, thank you, folks. Reach out to Ishpreet, lot of money. Ritesh, lot of money. Founders for awareness.